Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Welcome back to Big Money Real Estate. I'm Ilyce. Here's your daily update. A little over a month ago, I filed a report about the impending wave of HELOC resets, that's home equity line of credit, from the housing boom days. These resets mean that many borrowers will see their payments more than double as the 10-year interest-only draw periods wind down and the combined payments on principal and interest kick in. So I've asked Greg McBride, he's Bankrate's Chief Financial Analyst, to come back on the show and share his advice about what borrowers who are facing this very difficult financial move should actually do to cope. Hey, Greg, welcome back to Big Money Real Estate.
Thanks for having me, Ilyce.
So let's talk about the size of the numbers, the sheer numbers of people that this might happen to.
Well, the OCC estimates that we're looking at about $40 to $50 billion worth of HELOCs resetting each year, not just this year, but each of the next 2 years as well. And this is something that, has the potential, even if it's not systemically disruptive, it certainly has the potential to be disruptive at the household level. People that don't know this is coming or are ill-prepared and get caught flat-footed.
So we've got about 3.3 million homeowners, existing HELOCs, that right now are that 158 billion. So you're calculating that over, 3 to 4 years, roughly 50 billion a year. The individual, typically these people were taking out $30,000 balances, and the recasting of the payments could end up that they're in a situation where they might double, their payments might double to maybe $170 to $180 a month from maybe where they are now, which is $70 or $80 a month. The other thing I think your survey found is that the vast majority of these are attached to homes that are underwater. So what kind of trouble do you think that we're really in here?
Well, I mean, those are the people that I worry about, at least, the people that are underwater, the people that they've been skating by on the interest-only payments for the last 10 years. They haven't really made a dent in the balance. And oh, by the way, we really haven't seen much in the way of wage growth, right? So the ability to handle that higher monthly payment for a lot of people, I think, is going to be constrained. So for the people that have some equity in the home and aren't underwater, they have a couple of options. I mean, the mortgage rates as low as they are right now, a lot of people are looking to refinance the first mortgage anyway. You could wrap the HELOC into that and lock in a fixed rate on all of your home borrowing. You could look to just refinance the HELOC itself. What that basically does is restarts the clock on that draw period and kicks the can down the road. But if you're underwater, then your options are much more limited. I think in that case, you've got to get on the horn, talk to your lender right away, see what they can do about either stretching out that repayment period so the payment increase isn't as dramatic, something to just basically buy you some more time to benefit from the recovery in home prices and the paying down of that balance to get into a positive equity position.
Are we making the assumption that people who are underwater are naturally going to have trouble making these payments? Because in a large swath of Georgia, for example, those houses are underwater, but people have jobs and they are actually getting by. So are we making too much of this connection?
Well, the problem of being underwater in and of itself isn't the problem. I mean, that itself is not a catalyst for default. If that were the case, we'd see new cars parked by the side of the road day in and day out as people realize that, oh my goodness, that car I bought 2 weeks ago, I'm really underwater on. So being underwater in and of itself isn't the problem. It becomes a problem when you intersect that with something else, either the need to sell the home or a big increase in payments that you can't handle. Then it becomes a problem. So it's not the number of people that are underwater that concerns me. What is a bigger concern to me are the number of people that don't know this is coming and don't have the room in their household budgets to absorb this payment increase. If they're in that situation and they're underwater, that's where it's particularly problematic because their options are limited.
So when we look at the numbers, and I think you probably have kept your eyes on this, what is your sense of how much home prices, which have gone up, have floated up, have helped to calm the situation where there's 3.3 million homeowners who are in the situation where their HELOCs are going to sort of rejigger and go up after the 10-year period? Over these next few years, as home prices continue to go up, how many people are just this is going to be a non-issue for them because the home price is rising, so they're no longer going to be underwater?
Yeah, I mean, I think that's really, I think that's a real benefit. And keep in mind that a lot of these home equity lines of credit that are going to be resetting, a lot of them were concentrated in the so-called sand states, Arizona, California, Nevada, and even Florida, that were the biggest movers during the housing boom, where people had the most equity to play with. Well, a lot of those markets have also seen the biggest rebound in home prices. So that's going to be a real benefit. The problem is, regardless of where you live, is the fact that if your budget's not in a position to handle this payment increase, that's going to be the problem. So I don't see this as a systemic risk, but at the household level, it could be a problem if you're not prepared for this and if you can't handle that payment increase.
What do you suspect, or have you seen any numbers about how much foreclosures or short sales or other kinds of delinquency numbers may pop when these all start to hit this year?
I haven't seen specific estimates on that. I think you will see a little bit of an increase, but not enough where it's going to be. I certainly don't see a wave of defaults. You will see, I think, a slight increase, but we're talking about pretty modest numbers spread over a period of several years. So I don't think we're looking at something that's a risk to the economy, and maybe not even much of a headwind to the overall housing market itself. But that's little consolation to the homeowner who is, really behind the 8 ball on this.
Well, refinancing your mortgage or your HELOC with today's interest rates, you can't beat that. I mean, the rates are still ridiculously low.
Yeah, absolutely. It's a great opportunity. I think for people that have equity, this is a good timing, simply because fixed mortgage rates are at 2-year lows right now. So you could refinance that home equity line, wrap it into that first mortgage refinancing that you were looking at doing anyway, and now you've locked in a fixed rate on all that home borrowing.
Which is just great information. Greg McBride is Chief Financial Analyst for Bankrate.com. Hey, Greg, thank you so much, and we hope to have you back soon.
Always a pleasure. Thank you so much, Ilyce.
All right. And thank you for watching this episode of Big Money Real Estate. Be sure to send us your home equity and credit questions on Twitter and Facebook, and share this video all around. Until next time, I'm Ilyce Glink.